The current growth of insurtech and the Internet of Things have led to a significant increase in the collection, storage, and use of diverse amounts of information by insurance companies. Often referred to as big data, this information boom in the insurance industry has been described by the NAIC as unstructured and/or structured data being used to influence underwriting, rating, pricing, forms, marketing, and claims handling. Insurers often seek to use big data to more accurately underwrite and assess risk, incentivize risk reduction, reduce fraud, and provide quicker claims servicing. The NAIC recently formed the Big Data Working Group. The working group identified several regulatory concerns stemming from big data, which include a lack of transparency and potential for bias in the algorithms used to synthesize big data, highly individualized rates that lose the benefit of risk pooling, insurance regulatory resources for reviewing complex rate filings, the collection of information sensitive to consumers' privacy or potentially discriminatory, and cyber threats to stored data. The working group also reviewed the current regulatory frameworks and determined that there is a need to improve the regulatory framework regarding an insurer's ability to use specific consumer data. With this backdrop to the current concerns facing regulators, insurance companies should consider the following regulatory issues that could impact how insurance companies are able to incorporate the use of big data into various segments of their business. Price optimization does not have a universal definition, but generally relates to the use of factors or information not directly related to risk in establishing rates and premiums. With big data, there is a concern that insurers can use data in complex algorithms to determine how much of a price increase a customer will accept before going to another competitor. The use of big data by insurers raises questions related to unfair discrimination. Most state insurance rating laws prohibit insurance rates and rating factors that are excessive, inadequate, or unfairly discriminatory, and also generally treat unfair discrimination as a type of prohibited unfair insurance practice. Recently, the Federal Insurance Office identified a concern that certain methodologies utilizing big data may hide intentional or unintentional discrimination against protected classes by segmenting customers that are closely correlated with race, gender, ethnicity, or religion. As insurers begin to utilize additional information in underwriting and pricing, it remains to be seen if state regulators will prohibit or limit the use of new information on unfair discrimination grounds. Another consumer protection concern stemming from the rapidly increasing level of data collection is the threat to consumer privacy posed by any type of data breach. The NAIC recently adopted the Insurance Data Security Model Law to address this concern, making it available for consideration and adoption by the states in 2018. With state adoption likely to begin in 2018, it is important for insurers to become informed now of the model law's requirements so they can be ready to implement those or similar requirements when enacted by the various states. Insurers should continue to monitor developments from the NAIC's Big Data Working Group and the state's adoption of the NAIC Insurance Data Security Model Law to stay ahead of regulatory responses related to big data concerns.